Welcome to Markets and Economics. Stocks play a central role in the world of investing, offering individuals a way to own a piece of a company and participate in its financial growth. The stock market is where these shares are bought and sold, connecting investors with businesses seeking capital. In this video, we will explore the fundamentals of stocks, how the stock market operates, and why investing in stocks can be a powerful tool for building wealth over time. Viewers will gain an understanding of the basic concepts behind stock ownership, the potential risks and rewards, and how stocks have historically contributed to financial success. By the end, you'll have a clearer picture of how stocks work and why they matter for anyone interested in growing their money. Imagine a company as a large pizza. Each slice of the pizza represents a share of the company. When you buy a stock, it's like purchasing a slice of that pizza. Owning a slice means you have a piece of the whole, making you a shareholder. Just as every slice gives you a portion of the pizza, every share gives you a portion of ownership in the company. The more slices you own, the bigger your share of the pizza and the company. This simple analogy helps explain how buying stocks makes you a part owner, with a stake in the company's success. Companies issue stocks primarily to raise capital, which is essential for their growth and development. By selling shares to investors, businesses can secure the funds needed to expand operations, enter new markets, or invest in innovative products and technologies. This influx of capital also enables companies to hire additional staff, enhance their infrastructure, and improve overall efficiency. In some cases, issuing stocks helps organizations reduce existing debt, strengthening their financial position. Ultimately, offering shares allows companies to access resources beyond what traditional loans might provide, supporting both short-term projects and long-term strategic goals. Stocks are generally divided into two main categories: common stock and preferred stock. Common stock represents ownership in a company and typically comes with voting rights, allowing shareholders to influence corporate decisions such as electing the board of directors. Investors in common stock often seek growth potential, as the value of their shares can increase if the company performs well. In contrast, preferred stockholders usually do not have voting rights, but they benefit from fixed dividends, which are paid out before any dividends to common shareholders. Additionally, preferred stockholders have a higher claim on assets if the company faces liquidation. This distinction makes preferred stock appealing to those seeking more predictable income and greater security in the event of financial difficulties. The stock market is a vast network of exchanges, where shares of publicly traded companies are bought and sold. It serves as a central hub for investors to trade ownership in businesses, facilitating the flow of capital and investment. Among the most prominent platforms are the New York Stock Exchange, commonly known as the NYSE, and the Nasdaq, and National Stock Exchange (NSE). These exchanges provide the infrastructure and regulations necessary to ensure fair and transparent transactions. Together, they play a crucial role in the global financial system, connecting buyers and sellers from around the world. The financial markets are divided into two main segments: the primary market and the secondary market. In the primary market, companies issue shares to the public for the very first time through initial public offerings or IPOs. This process allows businesses to raise capital directly from investors. Once these shares have been sold, they move to the secondary market. Here, investors trade shares among themselves, buying and selling ownership without involving the issuing company. The secondary market provides liquidity and enables price discovery, making it an essential part of the overall financial system. Stock prices fluctuate due to a variety of interconnected factors. At the core, the principles of supply and demand drive these changes. When more investors want to buy a stock than sell it, the price tends to rise, and vice versa. company performance, such as earnings reports and growth prospects, can significantly influence investor decisions. Broader economic factors, including interest rates, inflation, and global events, also play a crucial role in shaping market trends. Additionally, investor sentiment, how optimistic or pessimistic people feel about the market, can cause prices to swing, sometimes independent of concrete financial data. Together, these elements create a dynamic environment where stock prices are constantly adjusting. Capital gains represent one of the primary ways investors earn money from stocks. This occurs when you purchase shares at a lower price and later sell them at a higher price, capturing the difference as profit. The strategy of buying low and selling high is fundamental to stock market investing. Over time, capital gains can significantly contribute to building long-term wealth, especially when investments are held for several years. By patiently allowing stocks to appreciate in value, investors can benefit from the growth of companies and the broader market. This approach underscores the importance of timing and research in making informed investment decisions. Dividends represent a second way investors can earn income from stocks, in addition to potential price appreciation. When a company generates profits, it may choose to distribute a portion of those earnings to shareholders in the form of dividends. These payments are typically made on a regular schedule, such as quarterly or annually. Investors can choose to receive dividends as cash, or reinvest them back into additional shares of the company. Reinvesting dividends allows for compounded returns, meaning your investment can grow more rapidly over time, as you earn returns not only on your original shares, but also on the new shares purchased with dividend payments. This strategy can significantly enhance long-term portfolio growth, especially when practiced consistently. Ultimately, dividends provide both immediate income and an opportunity for accelerated wealth accumulation through reinvestment. Stock buybacks occur when a company purchases its own shares from the marketplace. By doing so, the company reduces the total number of shares available to investors. This decrease in supply can often lead to an increase in the value of the remaining shares, as each share now represents a larger ownership stake in the company. Companies may choose to buy back stock for various reasons, such as signaling confidence in their future prospects or utilizing excess cash. Buybacks can also improve financial ratios, making the company appear more attractive to investors. However, the impact of buybacks depends on market conditions and a company's overall strategy. Understanding key stock market terms is essential for anyone interested in investing. Market capitalization refers to the total value of a company's outstanding shares and is often used to classify companies as small cap, mid cap, or large cap. Blue chip stocks are shares of well-established companies with a history of reliable performance and financial stability. Volatility describes how much a stock's price fluctuates over time, indicating the level of risk involved. The P/E ratio, or price-to-earnings ratio, compares a company's current share price to its earnings per share, helping investors assess whether a stock is overvalued or undervalued. Familiarity with these concepts can provide a solid foundation for making informed investment decisions. Stock indices are essential tools for tracking the overall performance of financial markets. They represent a collection of selected stocks, providing a snapshot of how specific sectors or the broader market are performing. For example, the S&P 500 includes 500 of the largest publicly traded companies in the United States, offering a comprehensive view of the US stock market. The Dow Jones Industrial Average tracks 30 prominent companies. NIFTY 50 includes 50 of the largest and most liquid companies listed on the National Stock Exchange of India, reflecting the performance of major industry leaders. Meanwhile, the Nasdaq index is known for its focus on technology and innovation-driven firms. By monitoring these indices, investors and analysts can gauge market trends, assess economic health, and make informed investment decisions. Short-term trading and long-term investing represent two distinct strategies in the financial markets. Short-term trading involves frequent buying and selling of assets, aiming to capitalize on rapid price movements. While this approach can offer quick rewards, it also carries higher risks due to market volatility and the potential for significant losses. In contrast, long-term investing focuses on holding assets over extended periods, allowing investments to grow and compound. Historically, long-term investing has tended to yield more stable returns, benefiting from market growth and reduced impact from short-term fluctuations. Each strategy has its own set of risks and rewards, making it important for individuals to consider their financial goals and risk tolerance before choosing an approach. Investing always involves a degree of risk and volatility, as market conditions can change rapidly and unpredictably. Prices of assets may fluctuate due to economic events, industry trends, or even global developments. While risk cannot be eliminated entirely, diversification is a key strategy to help manage it. By spreading investments across different asset classes, sectors, or geographic regions, investors can reduce the impact of any single downturn on their overall portfolio. Diversification acts as a buffer, helping to protect investments when certain markets or industries experience declines. This approach allows for more stable returns over time and can provide greater peace of mind during periods of uncertainty. Emotions such as fear and greed play a significant role in shaping investment decisions. When markets fluctuate, fear can prompt investors to sell hastily, while greed may encourage risky bets in pursuit of quick gains. These emotional reactions often lead to poor outcomes and missed opportunities. Successful investing requires patience, allowing time for strategies to unfold. Discipline helps investors stick to their plans, even during turbulent periods. Maintaining a calm and rational mindset is essential for making thoughtful decisions, ultimately supporting long-term financial growth. To begin your investing journey, the first step is to open a brokerage account. This will give you access to the stock market and a variety of investment options. Once your account is set up, take time to research companies that interest you, paying attention to their financial health and growth potential. You may also consider mutual funds or exchange-traded funds, which allow you to invest in a diversified group of assets. Starting small is a wise approach, as it helps you learn without taking on too much risk. Remember, investing is most effective when approached with a long-term mindset, allowing your investments to grow and compound over time. Mutual funds and exchange-traded funds, or ETFs, are popular investment choices for beginners. Both options allow you to invest in a collection of stocks, bonds, or other assets, rather than putting all your money into a single company. This approach provides diversification, which can help reduce risk by spreading your investment across many different holdings. Mutual funds are typically managed by professionals and are bought or sold at the end of the trading day. ETFs, on the other hand, can be traded throughout the day like individual stocks. By investing in these funds, you gain exposure to entire markets or sectors, making it easier to build a balanced portfolio without needing extensive financial expertise. Building wealth through stocks requires a thoughtful approach and a commitment to continuous learning. Understanding market trends, company fundamentals, and investment strategies can help you make informed decisions. Managing risk is equally important. Diversifying your portfolio and setting realistic expectations can protect your investments from sudden market shifts. Starting early allows your money more time to grow, thanks to the power of compounding returns. By combining knowledge, prudent risk management, and a long-term perspective, you can maximize your potential for financial success in the stock market. As we wrap up, Remember that expanding your financial knowledge is a powerful step toward achieving your goals. Staying informed can help you make smarter decisions and build a more secure future. If you found this information helpful, consider exploring more content on this channel. Here, you'll find a range of resources designed to support your journey toward financial literacy. Thank you for joining us, and we look forward to sharing more insights with you soon. Before you go, don't forget to like this video if you found it helpful. Share it with your friends who want to learn more about finance and investing. And make sure to subscribe to the channel. It really supports the work we do. Also, tap the bell icon so you never miss our new videos. And tell me in the comments, what topic do you want to learn about next? Your suggestions help me make the content you want to see.